face value, assume that they're correct. That's, not that. It's like a 10, 15% of Strategy's balance sheet. And that assumes that Bitcoin stays flat all the way until 2028. And so if that happens, the 4-year cycle would be completely broken, for one. But two, that assumes that Strategy doesn't do anything at all between now and then. And they've shown that in a single week, they can raise over $1 billion on the common ATM. They've also shown now that in a single week, they can raise $200 million off selling Bitcoin, and yet the price of Bitcoin goes up. And so there's a lot of things that can be done between now and late 2027 and mostly in 2028 if they actually needed to raise cash. But my guess is that all of that will either be bought back because they will be able to raise cash by selling more preferred or more common ATM, or they'll simply refinance and roll to another series. So not really a big problem in my view. There's lots of time and lots of options. The product is designed to be reflexive. MSTR is levered BTC. That's why anyone buys it. And so something that's trading down more than Bitcoin when the market's down, when Bitcoin's down, it just makes logical sense. I mean, it's actually trading down less on an MNAV basis than in the last bear market. And even on a relative to Bitcoin basis, it's trading down a little bit less than the last bear market. And so there is kind of this higher low setup going on. I mean, we'll have to see, right? We don't know if this is actually the bottom, but this is kind of how Strategy is designed to work. And that's why people are interested in it. So it's not a replacement for just buying and holding spot Bitcoin. It's for people that want that upside exposure, that want that levered exposure, that want the reflexivity. But the reflexivity, it does have to work in both ways. But as long as Strategy doesn't lose all their Bitcoin to a hack, that's the main risk, of course, then this is really not a similar situation to a Terra Luna or to an FTX or to any of these other situations in prior cycles that, blew up and broke.
If you look at the composition of Bitcoin options, it is much more call heavy than it is in traditional markets, especially in the larger markets, right? So if you look into S&P options or NASDAQ QQQ options, the NASDAQ ETF options, these markets are usually 1/3 calls and 2/3 put options. In the Bitcoin space, it's the other way around. It's 2/3 calls and 1/3 put. So there's a lot more demand for upside, for topside structures than there is in these broader indices.
It's kind of like a YOLO FOMO type of option trader in crypto.
Yeah. And this is a public that has always been there, has been trading on Deribit and now with HiBit, and they have been around. But the interesting trend is that this market started to get a lot more sophisticated. So today you have crypto hedge funds.
We should never ignore the CFTC, especially these days. I keep joking. I'm like, DCMs are so hot right now. DCMs are designated contract markets, which are derivatives exchanges, which is where, of course, prediction markets live in the United States. And now true perps, perpetual futures live in the United States. So everybody in crypto is now completely obsessed with DCMs. And I feel like there's a lot of lawyers and a lot of market participants that are all of a sudden like, oh, we need to learn about this. We need to pay attention to this. What's this all about? Obviously, a lot of the focus has been dominated by those two things, particularly as of late. Prediction markets, which, as everyone on this pod knows, it's not just a crypto thing. There's a lot of prediction markets that have nothing to do with crypto, but obviously those two things get conflated a lot. And perpetual futures, which that is a multi-trillion-dollar market offshore. We saw some major news, lately that is we're bringing true perpetual futures onshore. So there's a lot of unknowns linked to that news. I think that I like where the CFTC is right now because it is supposed to be a pro-innovation regulator, and that's what it is right now. It's pro-innovation.
It goes back to how I started this conversation, which is the reframing, because the phrases illicit finance, which I just used, so I'm part of the problem, and DPRK, which is the official name, are not tangible enough to people.
So what I've learned from Nick Carlson, who is the foremost expert on this stuff, is they want to be called DPRK, so I call them North Korea. Under all circumstances.
Yeah. No, I think you're right. And let's break down North Korea for a second. I know you do it on this podcast all the time, but They are building a nuclear weapon system with the money that they hack from crypto. That is not just like a threat far away that will never touch crypto users in the United States or a financial system. Like, that is a real threat we need to be thinking about. So to me, it's just making it all more tangible. Like, what is illicit finance? That is a terrorist that could bomb a town that has vulnerable people. So like, let's just put that into a framework. And I'm not sure exactly how to make that more tangible, because sometimes you need to explain concepts, but it's really like, what is illicit finance? So that's number one.
Institutions really want access to crypto and they want access to DeFi. And I think the misconception is that institutions want DeFi to become TradFi, but I don't think that's actually true. I think they just want DeFi to be safe. The power of DeFi is that it can be, all the things that we were talking about, like programmable and transparent and interoperable and composable, right? And so I think like institutions see the power of that, but they need to understand things like, where does control sit? What is the strategy? What the risks are? How do the assets move? What happens in a stress event? What diligence should they be doing? And how do they explain this to all of their like internal stakeholders? And so like the lesson for us at Veda has been DeFi is powerful. People want it. Everyday users want it. But the market needs to build products that are more usable, have better risk controls. Obviously, we need just more legal clarity around a lot of this stuff. We need better operational infrastructure. And we need just better interfaces and like user experiences between on-chain systems and the real world.
Well, if you put money in that, it's a failure. So, I mean, there's some civilization level learning. It reminds me when Druckenmiller was asked about his lesson from the dot-com bubble when he had successfully de-risked in December prior to the top. And he got back in when he saw his junior analysts were making too much money. And he said, I already knew the lesson. I don't need to learn the lesson again. Similarly here, look, there's no value accrual. I think the number of these tokens is going to be more than 90% worthless, or even 95. I think it'll be like 99%. Like, I think it's, the lessons haven't changed. The Sarbanes-Oxley is a good point. Sarbanes-Oxley, though, applies to companies that want access to public capital markets. These were de novo startups raising money and getting liquidity quickly, and there's no alignment of incentives between the shareholders and the operators. They get liquidity too quick, and then they have no reason to stay and grow and steward the project. We saw that too. People respond to incentives.
I first got into crypto because of the blockchain. I was running a clearing business. I was dealing with billions of dollars moving around the system. It was awful. It was risky. The tech was awful. And I'm like, oh my God, I can just like eliminate all my risk overnight with this technology. This is amazing. It was like, this blockchain is great. I haven't quite figured out the Bitcoin thing, but like the blockchain is pretty cool. And then I completely changed my paradigm because I realized that it's actually the crypto, it's actually the tokens that really matter. The blockchains are the rails. And why does it matter? It's because I could take anything, I can program it, I can create certain value accrual mechanisms. But what I can fundamentally do is put private property into the internet for the very first time. And I was like, that is the unlock. It's the private property. Now, when you think about value, sure, a lot of that private property is not going to have value. But to the extent that you're able to program something with the appropriate level of value accrual utility, the opportunities for value accrual are immeasurable.
If you hold crypto on your phone, your biggest vulnerability isn't your wallet. It's your carrier. AT&T, Verizon, and T-Mobile have been breached again and again, and SIM swaps are still one of the easiest ways for attackers to drain accounts. That's where Cape comes in, America's privacy-first mobile carrier. Same premium service, but Cape rotates the identifier on your SIM every 24 hours, deletes your call and text metadata after a day, and protects against SIM swaps with a 24-word recovery phrase that only you control. You also get 2 middle-to-end encrypted secondary numbers for banking and signups, so you stop handing your real number to every app that asks. Go to cape.co/unchained and use code UNCHAINED for 33% off your first 6 months. Fidelity has been researching and investing in blockchain since 2014, long before it was a headline. And they're hiring crypto and DeFi professionals to join their team and discover what's next in finance. Fidelity is looking for people with fresh perspectives from different backgrounds, whether it's tech, UX, or product design, whether you're crypto savvy or crypto curious, as long as you have the passion to make a real impact at a company striving to make finance accessible to all. Explore crypto careers at Fidelity today and make the decision that could change your future for the better. Visit crypto.fidelitycareers.com to learn more. That's crypto.fidelitycareers.com. Fidelity is an equal opportunity employer. Before we dive back in, a quick word about something we make ourselves. If you like the way we cover crypto on this show, clear-eyed, no shilling, just what actually matters, you'll like the Unchained Daily. It's our free newsletter that lands in your inbox every weekday, with the most important stories in crypto written by journalists, not marketers. No jargon, no hype, no...
Hi, everyone. Welcome to another episode of Bits and Bips, the interview. I'm your host, Steve Ehrlich, head of research at SharpLink, and we've got a terrific episode for you today. But as always, before we dive in, just a little bit of housekeeping. One, nothing that you hear or see on this episode should be considered investment or financial advice. Please see unchainedcrypto.com/bits and bips for full disclosures. And second, before we dive in, let's hear from one of our sponsors.
This episode is brought to you by Cape, America's privacy-first mobile carrier. Same premium service you'd expect from any other carrier, but designed so your number, your location, and your data actually stay yours. Get 33% off 6 months at cape.co/unchained.
All right, welcome back. So I'm here today with Niklas Kunkel. He is the founder of Chronicle Labs, an Oracle provider supporting the entire DeFi space with a heavy focus on tokenized assets. And we're going to talk about sort of the landscape of DeFi, where the growth of tokenized assets and how they're being integrated into the plumbing of the entire financial ecosystem. And really kind of one thing I really want to get into is how we can sort of understand the differences between various Oracle providers, given how critical they are to this space, and explore how the industry has sort of dealt with certain challenges over the years as well. So a lot to talk about. Niklas, welcome. Thanks for joining.
Yeah, thank you for having me. Huge fan of the show. I watch almost every episode. So great to finally be on here.
Okay, that's nice to hear. Nice to say. I keep trying to get my kids to watch, and they are not interested at all. All right, so let's really kind of get started, because Chronicle and yourself, it has a pretty interesting background. I mean, you've been in crypto for at least a decade at this point, and it's kind of started with MakerDAO, the DAI stablecoin, Psi. I think now it's called USDS, et cetera. It's a really fascinating project because it, in many ways, created the entire DeFi space. And what I find most impressive is that it's really never. It hasn't gone down. I mean, just like Ethereum itself, like it's operated through bear and bull markets alike, and it's one of the real success stories. And that's sort of the origin story for yourself and what you're building at Chronicle Labs. So maybe just for anyone in my audience who's not familiar with your background, could you just please walk us through what those early days were like and sort of how it spawned the idea for Chronicle?
Absolutely. Yep. So, my background, right? I was part of the founding team of MakerDAO, and I think looking back, it seems kind of like manifest destiny. But like at the time, there wasn't really any DeFi. The only stablecoin was Tether, and there wasn't like a ecosystem of, say, DEXs and lending protocols, right? So I think it was quite forward-looking at the time to say, oh, there's going to be this DeFi, and at the center of DeFi, there will be these stable coins, and we don't want centralized stable coins, we want a decentralized stable coin, right? I think like in hindsight, it all looks very obvious, but at the time, like it was very like out there and like experimental. And so even like Ethereum as a chain, like right, Maker was originally built on Ethereum. It had only been live for maybe like less than a year. There weren't really any apps on it, right? At least nothing serious. So we really had to build everything from scratch, right? And this is really kind of where, like, my journey started with respect to oracles. Is that one day we were building a debugger because there was no Solidity debugger, right? One day we're building a DEX because like it was actually the first DEX on Ethereum, and it was because Maker didn't have any funding, and we're like, how do we get funding? Well, if we build this like thing called a DEX, like we can sell some tokens and we can get some funding, and maybe we can pay salaries this month, right? Like it was very much DIY, build everything on your own, right? And that included like oracles, right? So this notion of an oracle didn't really exist, but we knew we needed a way to like externally price something in a kind of trustless manner, and that really kind of was the I guess like what set everything off for me.
Did you call it an oracle then, or what did you actually call that? And what you needed, correct me if I'm wrong, is you needed to be able to understand the price of ETH, because that affects the LTV for the stable coins that were borrowed against that collateral.
Exactly, right. So the way Maker works in a simple way is, you could lock up your ETH as collateral and you would borrow DAI stable coins against that. And so the protocol needed to know how much is an ETH worth, both for determining the initial amount that you could borrow, but also just maintaining like the collateralization, right, of the system over time, right? So if the price of ETH dropped, it would know which loans it would need to liquidate.
Yeah, and it's kind of. I'm sorry. And I mean, just going back through a little of the history of this myself as I was preparing for the show, I didn't even realize this, but it seems like a lot of the individuals that were those early day price providers were actually pseudonymous, because there were concerns that if they were identifiable, there could be pressure for them to manipulate the price and thus manipulate the value of DAI. And it seems it's almost like the antithesis of where oracles are today, where it's named participants who provide that information. And I'm generalizing across the whole span of oracles, but in exchange for compensation. So it's really kind of fascinating how, to me, like that you saw a security threat with that. And I guess we're overly cautious, or not overly cautious, but perhaps appropriately cautious to maintain the fidelity of the price feeds.
Sure. I mean, when you look at a DeFi protocol, right, the Achilles heel of any DeFi protocol is its oracle, right? It lives and dies by its oracle. If an oracle prints that ETH is $1 trillion, anyone can just go and drain all of the liquidity out of any lending market, out of any credit protocol, right? Similarly, if the oracle reports ETH is 0, you can liquidate all of the ETH positions, right, in a lending protocol, right? And you could potentially trigger, if you're looking at the likes of Aave and Sky, you could potentially trigger like a liquidation cascade on ETH, right? That has far more second order effects than just the on-chain liquidations.
Yeah, absolutely. And I guess just a level set for my audience. I mean, most people probably know what an oracle is, at least at a high level. But could you just briefly talk about like how deeply oracles have penetrated crypto? I mean, not across like different types of either assets or different DeFi protocols. Maybe put a few dollar amounts behind it in terms of either like TVS or the amount of like daily DeFi activity that, I mean, I guess in a certain way, almost all of it would require some degree of an oracle to understand price. But could you just sort of ground that in some numbers for the audience?
So I think it would be easier to say what are oracles not touching in crypto than to go the other way around. In simple terms, right? An oracle is like a data reference, right? So you have some data somewhere, and that somewhere can be, off chain, right? It could be another blockchain, right? And it needs to be transported to wherever that data is needed, right? So let's use like ETH as an example, right? You're fetching prices from all kinds of centralized exchanges, from Coinbase, Binance, OKX, Bybit, right? You're combining that with on-chain sources like, Uniswap. You may even be combining that with like, the ETH futures, on CME. You're aggregating all of this information, and then you're shipping it off, to the blockchain, right, where it's needed, so an application can consume it. And the primary two things here, right, that an Oracle needs to kind of concern itself with are, one, what are the data integrity guarantees, right? How do you ensure that this data has not been manipulated? And two, what are the data availability guarantees, right? How do you ensure that this flow of data continues and doesn't just stop, right? Because the second worst thing to happen to an Oracle is not that it prints a wrong price, but that it just like stops printing any updated price, right? And now a DeFi protocol, right, has no idea whether it is solvent or not, or whether it is issuing, safe credit safely, or whether it is like issuing credit at a loss.
Yeah. No, I mean, all those points make a lot of sense. And I think anyone that's followed the DeFi space over time has seen some of those concerns or risks really come to reality. I mean, we can talk about a few of the various sort of issues with price, from like the Mango Markets exploit, which was a quote unquote very profitable trading strategy, to even what happened on 1010, when I think it was, what was it, like USDE price was different on Binance compared to other exchanges. And
I think those two events are very different, though.
Yeah, of course. It more just suggests that, the importance of having accurate pricing and also, and again, like understanding too how, what trying to say, like finding ways to have accurate pricing, but also harmonize it across like various platforms and stuff. So there's not those like there's not those sort of hiccups that can lead to liquidations, etc. It just underscores the importance of the work that you guys do. So let's talk a little more about Chronicle Labs in particular, because one of the things I found really interesting about your company is how you really focus on RWAs now, and in particular, making sure that when someone buys a tokenized asset, they can be sure that the asset, the underlying collateral, is actually there. Like you maybe at the DTCC or just it's not a token that's minted out of thin air. So can you talk a little bit about what you guys do and sort of the problem that you're trying to solve?
Sure. So I don't think it's actually, our, iterating, right, and expanding into tokenized assets is really all that surprising or different from what we previously did. The role of an Oracle is to preserve the integrity of DeFi. And when DeFi was just using kind of crypto native assets, right, like a Bitcoin or an ETH, that was actually relatively simple because the protocol, right, was holding on to the actual asset. Mm-hmm. And so it just needed to know how to price that asset. With the expansion of DeFi into tokenized assets, I mean, there is an incredible opportunity here to, one, not just like expand DeFi out of its like very like self-contained scope, right, and open it up to the entire ecosystem, catalog of financial assets that are out there, mm-hmm. right? And this is incredibly attractive for everyone involved, right? From an asset manager, you can say, well, I want to give my clients, more utility with their assets, right? So if my client can, lend this asset to earn a yield, now I can provide like more utility to my clients, right? And so I think if you're looking at like a BlackRock or Fidelity, right, that's very, very attractive to them, right? And from a DeFi perspective, I mean, we're about to, take this from a $200 billion market, right, to a potentially, $100 trillion market, right? However, there is a risk here, right? And it's that tokenized assets, right, are not crypto native, right? And so regardless of whether they are, what you would call like a wrapper, or whether they are like actually issued on chain, but like the underlying assets are sitting somewhere off chain, right? That presents a whole new problem, right, for DeFi to deal with. And so it's actually imperative, right, that oracles are keeping up, right, and are ensuring that DeFi, through its integration of these tokenized assets, which I absolutely believe is necessary and critical, but that DeFi protocols can like maintain their integrity and maintain this like anti-fragile property, right? Like you mentioned earlier, right, that like it's amazing that like Maker has like survived, right, for not just survived, but like thrived for 10 years. And that doesn't just happen, through serendipity, right? That comes through like very rigorous analysis of like every part of the system and like every edge case that you can find yourself with, and really just like mapping out like how the protocol should respond in every single scenario.
Yeah.
And as soon as you open Pandora's box with tokenized assets, that problem becomes a lot more complex. And so, as an oracle, like we're here to simplify that. We're here to say, okay, here is this tokenized asset, and we can provide all of the metadata related to all of the context that comes with that tokenized asset. So a lending protocol like a Morpho, like an Aave, like a Sky, can handle it in a responsible, risk managed manner.
So let's ground this in just like one or two tangible examples. One of your clients is BlackRock, and I believe it's supporting their tokenized treasury fund BUIDL, which is the largest in the world. Talk to me about specifically what you are doing for them. What are the services? How do you, just kind of please walk us through that relationship.
Absolutely. Yeah. So very important relationship for us, right? I mean, BlackRock is the largest asset manager in the world. And, they recognize, right, the need for Oracle infrastructure when it comes to tokenized asset. So when you have something like BUIDL, from a protocol, like a DeFi protocol's perspective, it doesn't know what a BUIDL token is, right? Even if you feed it like a price, it can't account for all of the other, let's say like independent variables, right? And so what we're essentially doing is saying, okay, we can connect like to the back end where all of the assets are actually being held, right? And we can say and go, okay, we know, there is this treasury bill, that was bought for this amount. It's going to mature on this date, right? And it's going to be worth $100 at maturity. And, there is this overnight repo to JP Morgan, and there's this other overnight repo to Deutsche Bank or to Royal Bank of Canada, right? And so we can really rebuild the fund from like first principles, from the ground up. Like from saying, okay, here are the actual assets underlying the fund, and now we can recompile in a way like the entire fund. And so this way we can like independently like kind of come up with our own NAV and share price, right? Identify any kind of maturity, let's say blips, right? Like you want to have relatively like smooth like maturations, right? Like a portfolio of bonds and a portfolio of treasury bills, right? And so you don't want to see that like 30% of the portfolio, right, is going to mature in June, right? Or or next August, right? Because it means if the fund needs to do a bunch of redemptions, right, they could potentially need to sell some of those at a loss, right? And I think that problem is less pronounced with money market funds like Biddle, like other money market funds that we support, like Centrifuges, Janus Henderson, JTRSY, like Superstates, USTB. I think it's more pronounced in products that are like really popular right now are CLOs, because they are, as monetary policy rates are dropping, CLOs have higher yield, right? And so those are a little bit more interesting, right? But they're also a little bit less liquid, right? So that's kind of where the risk part of the equation comes in, right? And so Chronicle is really able to give you that like magnifying glass, like full view into like the guts of the fund. So a DeFi protocol can like basically plug that into their risk management system, like to handle these assets appropriately.
Okay. One more quick question, and then we have to take another break. But I just want to just drill down a little bit more specifically on what you're providing to BlackRock, because I just want to make sure my listeners understand. So your services, are you actually pricing the token or pricing the treasuries and the other elements of the money market fund that underpin the tokens, or is your job really to just verify that like what QSIPs are in there, like what the maturity dates are, if there's any like liens against them, like that kind of stuff, like what precisely is your role with just using that one engagement as an example? And then I guess, sorry, not to make the question more complicated, but it is interesting because like things like Biddle, or I guess maybe Benji as well from Franklin Templeton, et cetera, like they're starting to be used as collateral for and I would imagine that you probably get some questions from primes and other people that are accepting them to make sure that those assets are fully backed. So I'd really just love to kind of get a sense of that.
Yeah, absolutely. Right. So as I kind of alluded to previously, right, we are starting from first principles. So we don't take anything at face value, right? We know which assets are in custody, and we rebuild the fund, from there. What I mean by rebuilding the fund is, we say, okay, like we are pricing these T-bills using this methodology, and given all of the treasury bills in the fund, given all of the overnight repos and their expected yield, right, we are coming up with this NAV. Does that, how does that compare to what the fund admin is reporting? How does that compare to, how does the yield that's being reported compare and contrast to the yield that we are, calculating, right? So I wouldn't, I think the way to think of an oracle's role in tokenized assets is more of a neutral reconciliation agent, right? Because in traditional finance, you have all kinds of conflicts of interest, right? And so there is this separation of roles, right? So when you have like a fund, right, certain parties, someone will be a fund admin, someone will be a custodian, someone will be like a transfer agent, but you usually don't see like a lot of overlap in these roles, right? Take BNY as an example, right? BNY is one of the largest custodian banks in the world, right? Is the custodian for Biddle, but then on a different, product that we support for a securitized stack, right? BNY is the sub-advisor on that, right? And so they're acting like in this fund admin capacity. And so it's kind of the same in DeFi, where if you have a lending protocol and there's a risk curator and there's an oracle, you don't want the issuer of a tokenized asset to also be the one that is like reporting like the pricing data into a market, right? The same way you don't want like a risk curator of the market to also act as the oracle. There needs to be like this separation of duties, right? And so the oracle, right, really nestles in nicely into being able to be like this neutral arbiter of like, these are the facts relative to this tokenized asset. And so whether those are, I think it's important, right, that you're not just doing Simon says, right? Like not all oracles, like I think, go about this the right way.
Yeah.
But it's important that you're not just doing like a Simon says, like the issuer told me this or the asset manager told me this, right? That you're really going as far back into the chain as like down this like let's call it like the factory line that like comprises a tokenized asset, and are really just like checking every step in the way, right? And like it's okay to report what a fund admin reports as long as you have reconciled and determined that those numbers are accurate.
Yeah,
right?
It's funny. This reminds me of my interview I guess it was last week, with someone who is a provider of basically an index for GPU computing. I think the first one that was really kind of out there. And she told me that she's been getting flooded with inquiries from like perp DEX providers that want to make markets. And they asked her if she would be willing to sort of make a market on her index. And she flat out said no, because of the perceived conflict of interest in I mean, not that she would, I guess, try to manipulate the price for the index to go up, but certainly the ability could be there for someone who was perhaps a little less honest. So I understand the importance of what you're saying there. Okay, let's take a very quick break, but when we get back, we're going to talk more about where the RWA market is going, how oracles such as those provided by Chronicle are going to fit into it, and a lot more. So stay tuned.
If you hold crypto on your phone, your biggest vulnerability isn't your wallet, it's your carrier. AT&T, Verizon, and T-Mobile have been breached again and again. And SIM swaps are still one of the easiest ways for attackers to drain accounts. That's where Cape comes in, America's privacy-first mobile carrier. Same premium service, but Cape rotates the identifier on your SIM every 24 hours, deletes your call and text metadata after a day, and protects against SIM swaps with a 24-word recovery phrase that only you control. You also get 2 middle-to-end encrypted secondary numbers for banking and signups, so you stop handing your real number to every app that asks. Go to cape.co/unchained and use code UNCHAINED for 33% off your first 6 months.
All right, welcome back. So I want to talk a little more about sort of where RWAs are going and sort of some of the unique challenges that these new directions could create for companies such as yours. I've been in crypto for almost 13 years at this point. I mean, probably as long as you have, if not maybe a little shorter, but I've been in since 2013. And I've heard on and on again about tokenization, RWAs, et cetera, and some of the promises that are offered. From most of my experience, they've been unfulfilled, although it does seem like today things are different. I think there's probably about like $30 billion in tokenized assets outside of stablecoins. The number may not be entirely accurate, but it's a ballpark. And there's a lot more. And it seems like 2 big categories are like money market funds, treasuries that we spoke about, but then also alternative assets, the ones that are not quite as liquid, private credit, et cetera, that tokenization could offer a way to sort of reduce some of these illiquidity discounts that they trade with. I'd love to get your thoughts on that part of the market in particular. Are you doing anything to support them right now, and where you think that could grow to?
Absolutely. I mean, I think we kind of get a frontline seat to seeing like where the market is heading, right? Because we see what clients are working on and how we need to adapt our technology to be able to support those use cases. As you pointed out, right, I think the shift over the last 12 months has, as monetary policy rates, have kind of steadied, is how, can we kind of increase yield, right? It's no surprise, right, that in DeFi, people love their yield. They love their kind of yield looping strategies, right? So the race has been to create products that are, attractive to that part of the market, right? And that's really where we've seen CLOs take off, right? So we saw, Centrifuge with Janus Henderson launch JAAA, right? We saw what else did we see?
I mean, Hamilton Lane and Acred.
Exactly. Yeah. Right. There was the Apollo Acredics, right? All of these which we actually support at Chronicle. And I think even just yesterday, or I think it was like 2 days ago now, we announced, right, that we were supporting Galaxy's first tokenized CLO, which, I think is quite interesting because, Galaxy, if they're getting into tokenization, I mean, they're going to be a really huge player. I mean, they have the network, and they sit kind of perfectly nestled in between, DeFi and on the TradFi side. So I think they're going to do really well. And I mean, like the product that we support there, right, is Galaxy is either directly or indirectly, right, letting people borrow against their crypto, right, against Bitcoin, against ETH, Sol, XRP, right, whatever it is. And so all that we are doing, right, is we are getting like the loan book from Galaxy, and then we're going to their custodian, right? We're going to Anchorage and we're checking like, okay, is there actually, all this BTC, all this Sol, all this XRP, all this ETH in custody? Can we trace every way, every Satoshi, that is claimed to be, as collateral on these books, right? We identify the liabilities, and now we can say, okay, this CLO is, I don't know, 200% collateralized, right? And so, okay, and it's yielding 7%, right? So it's giving pretty good yield, right? And so now, like anyone who wants to potentially buy this Galaxy CLO, right, like can see, okay, look into the guts and like know that like someone independent like Chronicle has like validated all of this. But two, now someone like Morpho, you can have a vault and you can create like a looping strategy on this, right? So you can juice your 7% yield into 14 or 21%, right? What have you, right? And that's really like what, like, it's this two stages of like what Chronicle enables. Like one, it's the transparency that gives like the confidence in these assets. And then two, right, it's the ability for DeFi, right, to integrate them.
Yeah.
So in terms of like what's coming up, we're seeing, for example, like REITs, like real estate investment trusts are, there's a couple of those coming out. So we're excited about those. I think you may have seen Centrifuge just announced with New York Life that they're going to be releasing a new fund as well. I think kind of equities right now are really hot, and I think it'll take a while to get there, right? Like you were alluding to before, right? That there's like all these promises, and some of them have panned out and some of them haven't. I don't think it's a matter of it doesn't pan out. I think it's more a matter of just like it needs more time than anyone thinks it does. But like the promise is huge, right? Like if you have some stock, if you have Tesla stock and you want to go borrow against your Tesla stock, like your broker is going to charge you like very high single digits, low double digits, right? Versus in DeFi, I mean, if you're going to lend these things with I don't know, LTV of like 30% or something, right? DeFi will like offer you like mid to, high, single digits on this stuff like all day. Like if you look at what do you get for lending USDC? You're getting 2.7%. You're literally getting less than T-bills. Like, so I think there's really an opportunity, right, for DeFi to kind of be the mechanism where it can, one of the flywheels for tokenized equities taking off is just going to be this ability to get leverage against your equities at like much cheaper rates than you can in TradFi with your broker.
Yeah, one thing I was actually kind of really dying to ask you is I want to get your thoughts on some of the, I guess, controversy that surrounded, like, for instance, the SpaceX IPO and some of the markets that were spun up, where people were able to kind of bet on the price of some of these pre-IPO shares or private market shares. And I know with the SpaceX, I mean, I think there were a couple of like tokenized providers that had to give back the money because they weren't able to procure the shares out there. And I mean, that seems to be like the types of issues that a company like yours would, I guess, make sure do not happen. Yeah.
Yeah, sure. I mean, at that, it's people didn't know what they were buying, right? They were buying an SPV on an SPV on an SPV, right? They had like second degree, third degree exposure. And yeah, when it came time to, hey, I want to get my shares, right? A lot of these things blew up, rather from fraud or just improper legal structuring, right? Or just they never got the shares, right? But yeah, right. This is really what Chronicle is here to do, right? Is just give you absolute end-to-end transparency into everything, right? And that's what's going to keep DeFi anti-fragile. That's how we're going to scale DeFi with tokenized assets and keep DeFi, from not having the same systemic risks that we see in the traditional financial industry.
Yeah, and I also wanted to get your thoughts on. You talked a little bit about like looping and just additional ways to get yield. Obviously, like CLOs, private credit, et cetera. There is the promise, I guess, to make more money, even though the industry is a little under assault in recent months. But like I said, I'm really interested in your thoughts on what happened with the KelpDAO account, and in particular how it affected Aave. Because I wouldn't have to like rehash the entire story of what happened. I would imagine just about everybody listening and watching knows or could quickly look it up. But because of like the unbacked wrapped ETH or whichever one it was, the markets basically froze up. I mean, I know Aave had one big liquidity pool. Morpho is more segmented, et cetera. So I get that there's some design differences, but it led to some very hard decisions. It led to, I mean, I'm not getting into what happened with Arbitrum and what they did to freeze certain funds, but it led to, it exposed a lot of cracks in DeFi infrastructure. And one saving grace, I think, is that it was primarily contained within crypto. For everything that happened, as bad as it was within crypto. But if people are going to start using tools such as yours to deploy looping strategies across DeFi with like actual real world assets, not just like derivatives of ETH, that could become very, very problematic, especially with assets that where, like, for instance, the spot price may not be the liquidation price. I actually wrote a story when I was at Unchained on ACRED in particular. I noticed, I think, a mistake in some of the marketing material where it's an interval fund, which means you're not supposed to be able to get out your money. You can only get out your money on a quarterly basis, and they can cap the redemptions. And I think there were some discrepancies inadvertently on the marketing surrounding that. But it just shows the danger of these types of products when people are just thinking about dollar signs. And I'd love to just get your thoughts on kind of what are some of the lessons learned for your business from that one exploit in particular.
I mean, I think it's very simple. I think what people fail to recognize is that all of these interop protocols, like a layer 0, right, like a Chainlink CCIP, that's an oracle. Anytime you use like, cross-chain communication, anytime you're doing bridging one token from another token, a token from one chain to another chain, right? Yeah. These are all oracles, just white labeled with a different name, like cross-chain or like bridge. So it really comes down to the layer 0 oracle was compromised, and the DeFi protocol was insufficiently, risk managed to deal with that. And so it doesn't really call into question like, oh, oracles are bad. No, you need oracles, right? But you need to be very careful about which oracle you choose. And when you're deciding, oh, well, this one like costs a little bit more, right? I'm going to go with the cheaper one. You need to understand like the choice that you're making, that you are directly trading security, right? The security of your users, of their funds, of the ability, the existential risk of your protocol or your company, right? To save a few bucks, right? And like, I think, I think the bad players, right, get weeded out over time, right? And you see like players like Chainlink, like Chronicle, right, that have the Lindy, right? We've gone, I think, not quite 10 years. I think we launched like the first oracles on Ethereum in May of 2017. So come May next year, we'll be celebrating 10 years on chain without a single oracle hack. Right, and that's right. That's like what you don't see, right? That's in like the marketing material, is just like this, because you don't luck your way into 10 years, without an incident, right? That comes from a culture of just extreme delusional, psychotic like focus on security and durability.
Mm-hmm. How do you? I'm curious, and forgive me, I may not just be familiar enough with your business model, but how do you account for something like that, like a token that, like for instance, a BITL token, and I know I think it's based on Ethereum, but I don't know if it's available on other chains or not. Maybe. Mm-hmm. But like, how do you make sure that if certain tokens need to be able to move cross chain, or even like across like L2s, for instance, that mm-hmm. like what would you do if somehow somebody was able to trick layer 0 or one of those connectors to mint unbacked tokens? Like how would you handle something like that for one of your clients?
So on the lending protocol side, so I'll just use Aave as an example here because we're talking about the KelpDAO incident. Mm-hmm. But this goes for any lending protocol. They need to have circuit breaker safeguards in place, mm-hmm. right? And whether they are getting that data on their own or whether they are getting it through an oracle, they need to have those risk systems in place, right? So in the KelpDAO incident, right, an attacker, right, was able to convince the bridge, right, that with this false message to unlock the locked KelpDAO, right, on Ethereum, right, that shouldn't have been unlocked, right, because the corresponding kelp on the source chain, right, was not actually burned, right, to mm-hmm. do this. From a risk management perspective, you should be checking the supply on every single chain that a token can be on, right? And like summating those and like ensuring, right, that there is no mismatch, right, between the amount that is floating around versus like the amount that the token, like even just asking the token contract, how many RS ETH exist? That's not enough. Like, and if you notice any wonkiness, what do? You immediately freeze the market. You do not allow anyone to, have the protocol take on any more risk, right, by taking on more debt against these assets, nor do you allow anyone to like repay and like take stuff out, right, until like this whole mess is sorted. You just pause.
Yeah.
And it's just, this has nothing to do with tokenized assets already. This is just like a slightly more complex, let's call it like a DeFi asset, right? And we're already seeing lenders struggle to keep up with the complexity of that when the risk management solutions are quite simple, mm-hmm. right? And so when it comes to tokenized assets, the complexity of this just becomes, exponential, right? And so, yes, it's on the oracles, right, to develop the ability, right, to get all of the required data, all of this metadata, all of this context, right, compile it, so it can plug into the risk management systems of these lending protocols. But the onus is on the lending protocols, right, to take that risk management seriously, right, and to mm-hmm. create these, not like a phone call or there's like an alert that goes off or something. That's already too late. Yeah. It needs to be real time, automated, and triggered by data that is provably correct.
Mm-hmm. What do you see as the biggest areas of growth for your business in the next, say, 5 to 10 years?
I mean, it's hands down tokenized assets.
Even within like the dissimilar tokenized assets, like particular asset classes.
Let me paint you a picture, right? So today, Chronicle secures just under $15 billion across DeFi and tokenized assets, right? So we're not quite at Chainlink level, but we're 5 times larger than say like a Bith or a Redstone, right? It's not even close. And within that business, right, about 10 billion of it is pure DeFi, and 5 billion of that is tokenized assets. Those 5 billion in tokenized assets, we have done that over the last 18 months. Like, we didn't release our tokenized asset oracle till January of 25. Right. So that is easily by far, right, the fastest growing part of our business. And, I expect that, by the end of the year, frankly, the tokenized asset business, will be bigger than our pure DeFi business.
Okay.
On that front, to me, it has to be the equities. There are problems that you have with funds that you don't have with equities and vice versa. And I think there's like a kind of like step function kind of here. Like, you're not going to see very like gradual incremental growth. I think you're just going to see like huge like S curves, like localized S curves, like play out. Like, I'll give you an example, right? On the money market fund side, right? Like, these have existed for a while now. People, we know people in DeFi love to do their little leverage loops and stuff. One of the problems, not just with money market funds, but like with these CLOs and like other types of funds, is the redemption like ability, right? You touched on this earlier, right? With the ACRED product, like, okay, you can only like redeem on a quarterly basis, right? So there's kind of a problem here where you can get into the position if you want to build a leverage position. You can enter it very easily, right? Lock up your ACRED, lock up your JAAA, lock up your BIDL, your USDBs. You borrow against them. Great. And then you just go and you buy more of that initial asset, right? And so you can enter a position extremely efficiently. The problem is when you want to unwind this whole thing. In DeFi, we have like a flash loan, right? You take out a flash loan, you repay your whole debt. You can now withdraw your entire collateral, and now you can sell your collateral on a DEX, and you use the proceeds from selling your collateral to repay the flash loan, right? And that's that's an amazing superpower that DeFi has. However, now when it comes to the underlying, if the underlying asset is not something that you can just sell on a DEX, right? There's like millions of dollars of liquidity for, I don't know, some private credit product or for some like CLO on a DEX. Well, what do? Right? Someone needs to essentially like offer a like redemption facility, for a fee, right? And essentially take on either directionally take on that like underwriting that risk, or like find ways to hedge that on the other side, right? And so that's still been like a really big piece that's missing. But like just recently, for example, we saw Grove, who shout out, a great group of guys. They just did their TGE a couple days ago, so cool. They launched a new product called like Grove Basin. And essentially, like for right now, they're just supporting money market funds like BIDL, like Centrifuge, and Sanderson's JTRSY. But they'll now basically they have a $1 billion like credit line from Sky to just in kind, allow you to redeem your JTRSY or your BIDL for USDC, right? And so now you can exit these positions extremely efficiently. And, not having to go to like the issuer and do stuff, like paperwork stuff or do stuff off chain, right? It's all just in a transaction, right? Completely composable, one transaction, right? DeFi at work.
Yeah.
Right. Okay. And so it takes like new utilities like that just unlock like the ecosystem. Like it's like a bathtub, like filling with water, right?
Yeah.
Like there's only if the bathtub is this size, there's only a certain amount of water that can fit into it, right? As soon as we like open up like these new primitives, now all of a sudden the bathtub is much bigger, and it'll fill up with water like immediately. I mean, greed is ever present, right? If there's money to be made, money will find a way.
Okay. We're just about at time, but I have one more quick question I want to ask you. Tokenized assets are clearly a growth area, but we are starting to see some issuances directly on chain without an underlying, like, more traditional asset backing it. I'm just curious your thoughts on that and how you might account for it moving forward.
So actually, it's kind of funny because I get this question a lot. Like, it's supposed to be some kind of gotcha. I don't
mean,
really see
it's not meant to be a gotcha. It's just
yeah.
it's more just sometimes, like, for instance.
Mm-hmm.
Yeah, it's not meant to be a gotcha.
No, I understand, right?
Yeah.
So
why have something that's backed by something, whereas something could just be issued directly?
So one thing I want to say, for example, is you can have on-chain issuance where the assets are still, like, custodied off-chain, right?
Mm-hmm.
So an example of this is the new BNY Bailey Gifford product that was, like, just announced recently, where it's issued natively on-chain, right? But the underlying loans, like in the fund, right, are still, off-chain, right? And so those will still require, what I kind of consider like the very standardized, like, Chronicle proof of asset Oracle.
Mm-hmm.
Now, you mentioned specifically, right, funds that are issued on-chain, right, where the components of the fund are also on-chain.
Like,
right?
for instance, like JP Morgan just announced they're going to issue a money market fund on-chain.
Yeah, but where are the underlying T-bills for that money market fund? Sure. Are they off-chain or are they on-chain, right? I would tell you they're going to be off-chain.
Can't wait for the day when the Treasury starts issuing bonds on chain. That would be awesome.
But let's like take this example further, right? Like, let's assume, that, like, we start tokenizing individual T-bills, right? That's really cool, right? Now we can actually create, like, a natively issued, on-chain money market fund where even the underlying T-bills are on-chain, right? But you still now have the problem of, like, okay, well, I know that the money market fund is composed of these, on-chain T-bills, but how do I know that these on-chain T-bills are actually legit, right?
Mm-hmm.
And so it just becomes like the recursive problem of, again, I need to, like, go back and, like, now I need to have like proof of asset for the underlying T-bills all over.
You still need to find that source of truth, I guess, one way or another.
Exactly.
Okay. All right. Well, we need to end it there. So yeah, Niklas, thanks so much for joining. We'll have to have you back again. Thank you to everybody for watching and listening today. That's it for Bits and Bips, the interview this week. But don't go anywhere, because up next, Laura's going to sit down with Vlad Novakovsky, the founder and CEO of Lighter, the DeFi exchange Robinhood just made its perps engine inside its own wallet. She's going to break down how the deal happened, the fight with Hyperliquid, and when US traders can get in. So all in a few minutes, so don't go anywhere.
Matt's analysis, I don't have the numbers exactly in front of me, but, let's just take them for their face value, assume that they're correct. That's, not that. It's like a 10, 15% of strategy's balance